You've come into some extra money. Maybe it's a work bonus or a raise in your salary, or you've got the money by carefully trimming your regular spending. Feels great, doesn't it? But now comes the hard part, deciding what to do with it. You could just blow it all, of course, but you're not going to do that, are you? Because that's why you clicked on this video. So, what should you do with the money? Should you use it to pay off debt, build your savings, or invest it for the future? Hello, my name is Anthony and I'm a financial planner, an award-winning financial planner and the author of The Anthony Plan, a no-nonsense framework to help you take control of your money so you can build the wealth you need to live a life you love. Now, over the last 30 years or so, I've worked with hundreds and hundreds of people, just like you, people in midlife who work really hard, built careers, grown businesses and raised families, and yet still felt that pressure of financial uncertainty, until they met me, of course. Figuring out the right choices for your money is a dilemma that many of us face in midlife. And it's not made any easier when we've got all these competing priorities pulling us in all directions. So in today's video, we're going to explore a simple, step-by-step process to help you decide where your money really should go. So let's dive in. Right then, I'm going to assume that you've already got an emergency fund, say 6 months worth of spending, tucked away, ready for life's unexpected surprises. Because stuff happens, cars break down, boilers conk out, all sorts of unexpected things crop up. Now, an emergency fund protects you from going deeper into debt, and it gives you peace of mind. Now, if you haven't already got an emergency fund, or if you've not got enough in it, don't worry, I'm not going to judge you, but your job number one should be building that emergency fund first. I've got another video that walks you through exactly how to build an emergency fund if you need a bit of extra help. Not all debt is created equal. So let's break down the two kinds of debt. The good kind, the bad kind. The good kind of debt helps you buy assets that will grow in value over time. Good debt creates wealth. Think buying a home or buying a business. Think mortgages, business loans. The bad kind of debt, though, is used to fast-track consumption. Think credit cards, store cards, auto finance, and other personal loans that you use to fund discretionary spending. Bad debt enables you to spend tomorrow's income today, and it destroys wealth. Credit cards, payday loans and other secured debts, they often come with massive interest rates as well, 20% or more. And that can make you feel like you're running uphill with a bag of bricks on your back. Hard work. Mortgages, on the other hand, they typically have lower interest rates, currently somewhere in the low to mid single digit range, which makes them less of an urgent burden. But they can still be a drag on your financial progress. And so we'll make sure that we explore whether it makes sense to pay mortgages off sooner or redirect your extra money somewhere else. Now let's get into the nuts and bolts of making your decision. There are some really important factors that you need to consider. First of all, cost versus return. Here's a simple rule about numbers. If the interest rate on your debt is higher than what you could reasonably expect to earn by putting your money on deposit or investing it into something like the stock market, then it's usually best to pay off the debt. Just think about it. Let's say you've got a credit card with 18% interest rate. I know that's quite low for a credit card, but paying that off is like earning 18%, guaranteed, and you're not going to find that kind of return anywhere else. On the other hand, if your mortgage is charging, say, 3% interest a year or less, just as an example, and you compare that to the stock market, which historically has averaged around about 6%-ish a year over recent decades, then it might suggest, theoretically at least, to consider investing in the stock market instead of paying off that lower interest mortgage. Theoretically. Now, these are not my numbers about the stock market. I've not just made them up. These are the numbers that are collected from all around the world by a group of academics each year, and then they put them all together and then publish them for the world to consume in the Global Investment Returns Yearbook. They've got numbers going back every year to 1900, and according to the numbers, stock markets have delivered a consistent average annual return over the last century of just under 6% in real terms after taking into account inflation. Personally, professionally, I always like to plan for 5% average return because I'm cautious and I like wriggle room. Remember, past performance isn't a guarantee of future results though, but it is a really good benchmark for us to work with. Next up, time horizon. You need to ask yourself this: if you're not going to use the money to pay off your debt, when will you need to get your hands on the money? And will it be because you'll need the money to pay off that debt in the future, like a mortgage or something? Or will you be investing it for something else? See, this is really important because it directly affects where you should put your money, particularly if you're not going to use the money to pay off debt straight away. If, for example, your time horizon is short, if you need to get your hands on the money in the next couple of years, then really you want to stick to low risk, high liquidity options. Think cash. Think high yield savings accounts. Why these, Anthony, I hear you ask? Why not invest in the stock market for just a year or two? Good question. It's because the stock market, we know it can go up, but it can also go down an awful lot in the short term. Remember the COVID crash? Or the global financial crisis? Or the dot-com bubble bursting? It's not just the risks or the sleepless nights. It's just not worth it investing in the stock market if you need to get your hands on that money quickly, particularly if you're going to need that money to pay off a debt soon. Now, for longer term stuff like building a retirement fund so that you can retire or pay off your mortgage in, say, 20 years' time, then investing in the stock market is probably going to see the most growth over the next decade or two. Remember, the stock market rewards investors who stick with it over the long term, and it punishes those who want to just dip in and out over the short term. Okay? Now, let's look at some examples, shall we? Let's say you've cleared your high interest debts, credit cards and stuff, and you've decided that you're not going to use the money towards paying off your mortgage. Instead, you've decided you're going to use the money for a home renovation in, say, 3 years' time. Putting that money into a savings account at, say, 3% interest means that you'll be able to get your hands on it when you need it, and the interest rate it earns might be broadly similar to your mortgage interest. So at least it can potentially wash its own face, as it were, but only if the interest rates are favourable and they're aligned. But if you're going to invest your money for, say retirement in 15 or 20 years' time down the line, then the potential returns from the stock market are going to be much more attractive than cash, and potentially more attractive than paying it towards your mortgage. And if you decide to say, invest it into your retirement account and your employer also offers contribution matching, well, you can be onto a real winner. Look at this chart. $50 a month over 3 years, earning 3% interest versus the mortgage interest that you'd pay over that time at, say, 3%. And you can see there's not much in it. Compare $50 a month over a 5-year period towards your mortgage versus $50 a month invested. And then compare if that $50 a month invested received employer matching, and it equivalent to $100 total, yours and your employer's. Now you can see there's a big difference in the potential outcomes. Now, we talked about numbers, but money decisions are more than just the practical or the logical. They're also emotional. And the risks aren't always about making or losing money. Sometimes they're about how we feel about the decisions that we've made. Whether we'll sleep at night, or whether the high levels of stress from keeping debt or being invested could be damaging for our health. Now, this shouldn't be really underestimated at all. It is so important. Paying off debt offers certainty. It's a guaranteed win, and it feels really good. It's one less thing hanging over your head. Putting your money into short-term savings can feel quite safe. You know where your money is when you need it, but it only works if you can earn more than inflation, and only if it can earn a higher rate of interest than what you're paying on your debts. And then what about investing in the stock market? Well, that can feel downright scary, especially if you're new to it. You know what I mean? What if the market drops? How will you react? Will your reactions help you or harm you? Will you panic and sell at a loss and run for the hills? Or will you just sit tight and wait for the recovery? Now, all these fears and emotions are normal, but if left unchecked, they can hold us back from taking the steps that we need to build real wealth and real financial security. Let's look at another example. Imagine investing $10,000 in the stock market. I'm using this figure because it's a really nice round number and I like round numbers. Now, let's say 2 months after investing, the market falls and your balance drops to 7,000. It's easy to feel like you want to panic and pull your money out. But if you hold steady, history shows that it's going to recover and it'll even grow your wealth over time. And this is where emotional resilience comes into it. And then consider if you're investing, say, $100 each month when the market falls. Now that actually gives you an opportunity because you'll be able to use that $100 to buy more shares at a discounted price for 70 cents on the dollar, using this example. Now, one other important point. If you decide that investing is the right thing for you, you'll need to make sure that you've got your actions or reactions to these potential market swings ready in your own mind. This is where an investment map or market action plan comes into play. If you need a bit more help with this, grab your copy of my investment map workbook. Deciding whether to use your money to pay off debt, hold it on deposit, or invest it into something like the stock market is made so much easier if you have a process to help you decide. Think cost versus return, time horizon, sweeteners like employee contribution matching, the emotional impact and the characteristics of your investments. Let me know how you get on. If you've got any questions about this or anything else to do with your finances, you can get in touch with me through my LinkedIn profile or my Facebook page. Thank you for watching. If you found this video useful, please consider liking and subscribing, and we'll see you soon. Bye.